Yes, sir. Yo, what is going on, guys? Welcome to another video. Oh, we got a lot to get into this video because I actually took a look at the official SEC filing for me, Kevin's 3 different ETFs that he is starting. And y'all, there are some major risk and red flags in that document. We in today's video, we are going to go ahead and go over that. As you guys know, this is all about protecting the investor, right? We know this guy is extremely risky in his investments, makes bad decisions, buys terrible stocks. I mean, do I really have to go down the list again? Robinhood, Matterport, Shift Technologies, Outlets. Matter of fact, I actually have a Meet Kevin watch list. We're going to go over the watch list. Hold on, let me pull it up real quick. So we got Redfin, Pinterest, Tattooed Chef. Yes, he did buy Tattooed Chef at one point, guys. Never forget that. Wayfair, Etsy, Lemonade, Peloton, EXPI, Matterport. I mean, the list just goes on. But anyway, I took a look at his prospectus. For those who don't know, prospectus is a legal document that basically includes the description of the fund strategies and like the risk and all those different things and the disclosures and all that crap. So I actually took a look at it. And I wanted to give you guys the highlights. I think it's like 33 pages or something like that. It's pretty long. I think it includes like the information for all 3 of his little ETFs that he's starting. So what we're going to actually do in this video is we are actually going to go ahead and just go over it. So let's just go ahead and get started, shall we? So here we go. There's a section right here that says this. It says, the sub-advisor begins its analysis by screening an initial universe of U.S. listed companies with a minimum market capitalization of $100 million, utilizing a proprietary screening methodology. So that tells you right off the bat, we already know, guys, companies that have a market cap of $100 million are mostly what? Say it with me, folks. Penny stocks, super risky stocks. Why is he saying that? Well, a lot of his favorite stocks have become penny stocks now. Like Matterport's dang near penny stock, you know, Shift Technologies, Outlet. So it makes sense why he would have this in here. He's probably more than likely going to have some penny stocks in his ETF, which I strongly disagree with, but it looks like he's really going the Cathie Wood route. He's going to put all these speculative, unprofitable penny stocks in the portfolio. That's what it looks like, and that's why he has that language in the text, because he's protecting himself. Now, let's go ahead and keep going. It says right here, during periods when the sub-advisor believes there is significant risk to the market as a whole or a particular sector of the market, the fund's portfolio may hold up to 30% of its net assets in the securities of targeted ETFs to provide a macroeconomic hedge against the anticipated market risk. In those cases, the fund will hold ETFs that the sub-advisor believes will most likely benefit from the anticipated market risk. For example, the fund may hold ETFs that focus on particular industries, commodities, and/or provide inverse exposure to broad market indices. That means he's telling you that he's more than likely at some points in the portfolio going to invest in inverse ETFs. For those who don't know, inverse ETFs are extremely risky. So we got 2 red flags right now. He's already got the language written in there that it is perfectly fine for him to invest in penny stocks, companies with very tiny market caps of only $100 million. Then he's got the other language where he's telling you that he could or probably will put money at different points in the market cycle into inverse ETFs, which are very risky. Those are 2 huge red flags we are seeing. Let's continue reading. High portfolio turnover risk. The fund is expected to frequently trade a significant portion of the securities in its portfolio. A high portfolio turnover rate increases transaction costs, which may increase the fund's expenses. Frequent trading may also cause adverse tax consequences for investors in the fund due to an increase in short-term capital gains. That's red flag number 3. He's actively trading. That's what is going to be happening in that portfolio. It is an active fund where he's literally just going to be clearly he's going to be making moves. I don't know how often. I don't know if it's going to be days or whatever, but he's going to be making active moves. He's going to be trading, and he's letting you guys know up front, you will be subject to short-term capital gains taxes because of the short-term moves that they will be making in that portfolio. Absolutely insane. At least he's got the disclosure. High portfolio turnover risk. He's letting you guys know right now. Now, just based off those three flags, those three red flags that I've read alone, I don't know how anybody could be dumb enough to put their money in this. And yes, I know it's insulting to call people dumb, but I'm sorry, guys. We just got to call it out like we see it. A lot of people in investing on the retail side are just dumb. And it's unfortunate, but hopefully I can help at least save some of those people who have an ounce of brain power, just an ounce of brain power, because it just amazes me how people just don't read. People just, oh, me, Kevin, oh my God, my money. Oh, God. Like, what are you doing, bro? Did you read anything? Did you read these documents? Are you reading this language that I'm telling you right now? Do you understand how extremely risky this guy's ETFs are going to be? Or are you just saying, oh my God, me, Kevin, to the moon. I love him. I'm investing 25,000. Like, come on, bro. You guys got to be smarter than this. And it's frustrating to see so many people be so dumb to just throw money willy-nilly at somebody who just happens to be charismatic or likable or entertaining. Just because somebody is charismatic, likable, entertaining does not mean that they know what they're doing when it freaking comes to investing. Case in point, Matterport. Case in point, Shift Technologies. Case in point, Robinhood. Come on, man. All right. Enough ranting because I get upset. I get angry. All right. Says right here, management risk. The fund is actively managed and may not meet its investment objective based on the sub-advisor's success or failure to implement investment strategies for a fund. Another red flag. Okay, now we got the management section. This is the section where they literally tell you what's going on here. So it says right here, Toroso Investments LLC serves as investment advisor to the fund. So there you go. Investment sub-advisor. Says right here under portfolio managers, you've got Kevin Paffrath, who is a sub-advisor. You've got Michael Venuto, who is the chief investment officer for the advisor. And then you have Charles A. Regos, who is the CFA portfolio manager. So basically, this isn't even solely Kevin's fund. It looks like it does. Actually, it actually looks like he won't even be completely running the fund on his own. That's what it looks like right here. It looks like Michael Venuto is the chief investment officer. That's what it looks like. And it looks like Kevin Paffrath is just a sub-advisor. Okay, this part right here is also very risky. This section of the document kind of tells you what kind of companies he's mostly going to be investing in. It says right here, in particular, the sub-advisor considers each candidate company's track record of disrupting mature industries, electric vehicles, or operating within disruptive industries, i.e. social media, blockchain, and/or a company's historical patterns of launching hardware or software products that are first to market. The sub-advisor favors companies that remain founder-led, reports spending more on research and development than their peers, and have a strong history of customer satisfaction. I'm telling you guys, this entire thing screams risk. This is literally just another version of a Cathie Wood ETF, in my personal opinion. He's looking at blockchain, social media, electric vehicles, just all these speculative investments. And that's really what worries me. Can't lie to you, Kevin. I know you're going to watch this video. Pretty worrisome, man. Pretty worrisome. But if that's how you choose to invest, hey. Okay, it looks like I was wrong in what I said earlier, so I'm definitely going to correct it because I want to make sure that we get all the facts right here. So at first I thought that the other guy, the chief investment officer guy, was the one who was probably going to run a portfolio. But no, it looks like according to this, Kevin himself will actually be mostly running the portfolio. So it says right here, pursuant to the sub-advisory agreement, the sub-advisor is responsible for the day-to-day management of each fund's portfolio, including determining the securities purchased and sold, the funds, and trading portfolio securities on behalf of each fund, subject to the supervision of the advisor and the board. So it's subject to the supervision of the advisor and the board. However, the sub-advisor is the one who will be pretty much running it, which is Kevin in this case. The sub-advisor is paid a fee by the advisor, which is calculated daily and paid monthly pursuant to the table below. So it says right here under portfolio managers, each fund is managed jointly and primarily by Michael Venuto, Chief Investment Officer for the advisor, Charles A. Regos, CFA, Portfolio Manager for the advisor, and by Kevin Paffrath, Sub-Advisor and Portfolio Manager for the Sub-Advisor. So that's what we're seeing there. So it looks like those are the main three, but it looks like Kevin will definitely have a huge hand in doing this. Now here's where it gets interesting. Let's read this. Hold on. Okay, let's read this. Portfolio manager fund ownership. The funds are required to show the dollar range of each portfolio manager's beneficial ownership of shares as of the end of the most recently completed fiscal year. Dollar amounts range is disclosed or established by the SEC. Okay, blah, blah, blah. Let's skip. Portfolio manager compensation. Mr. Venuto is compensated by the advisor with a base salary and profit sharing plan. Mr. Venuto is an equity owner of the advisor and therefore benefits indirectly from the revenue generated from the fund's advisory agreement with the advisor. Mr. Rogos is compensated by the advisor with a fixed salary and discretionary bonus based on the financial performance and profitability of the advisor and not based on the performance of the fund. Oh, ho, ho. Let's read that again. So the CFA guy says he is compensated. Let me hold on. Let me actually fix this. Hold on, my bad. Hold on. Says he is compensated by the advisor with a fixed salary and discretionary bonus based on the financial performance and profitability of the advisor and not based on the performance of the fund. Okay, well, that was a lot of reading and that was a lot to go over. But anyway, we finally got through it. So there you guys have it. That'll go conclude today's video. Thank you guys so much for watching. Feel free to like, share, and subscribe. And I will see you guys in the next one.